Wait, is this a new way to invest in a
sure is,
diversified
Michael.
portfolio of bonds and receive monthly interest payments?
You're darn right it is.
What's the best part?
If you act now, you can potentially lock in a 6% plus yield until 2028. In other words...
So I don't have to worry about the Fed's upcoming rate cuts, Josh?
Well, you can worry about other things, but you won't have to worry about that.
How long does it take to get started?
Minutes? Seconds? Depending on how fast you type. But you have to act fast if you want to take advantage of some of the highest bond yields in years.
It's the new bond account, only at public.com/compound.
All right. Hey, everybody. It's Josh Brown. I'm here with my friends Nick Colas and Jessica Rabe. They are the co-founders of DataTrek Research and authors of DataTrek's morning briefing newsletter, which goes out daily to 1,000 plus institutional and retail clients. They're also two of the smartest people I know. I love that I get to check in with them every month just to see what's happening in the markets, in the economy, in technology, and elsewhere. Nick, Jessica, thank you so much for being here. How's everything going?
Going well.
Well, thank you.
All right. We just caught up on each other's weekends, so we're good there. Nick, you are talking a little bit about obviously the big question on everyone's mind. Did the Fed blow it? Are they too late? I wanted to just set the stage a little bit. The people that I talked to were mostly surprised that they went 50 and not 25, even though the betting odds in the bond market were basically an even split. I think people are just not accustomed to seeing the Fed start a rate hiking cycle with 50, especially if there's nothing going wrong in the economy, which so far seems like it's the case. I remember before the meeting, there was an open question about, would a 50 basis point cut do more harm than good? Would it spook the markets? And obviously, that is not what happened. Thursday's delayed reaction, we had a huge rally in the stock market. I felt like that was in keeping with some of the delayed reactions we've been seeing all year. It's weird. It seems like the algos act on Wednesday, and then the people speak on Thursday. And I want to get your take on whether or not I'm the only person seeing that phenomenon. But my take is like people sleep on it, and then the next day they wake up and buy something. There was also talk that the Fed wouldn't do 50 because it would implicitly be thought of as an admission that they should have done 25 last time. The fact that they went 50, maybe the positive thing to say is that Powell cares less about that kind of optics thing and cares more about getting the policy right itself. So that's kind of my take, but I'd love to hear where you stand.
Yeah, you're right. I mean, the day after a Fed meeting have been some of the best days of this year, and that was even the case in some parts of last year. So it does continue that pattern. I thought we'd just kick off the conversation with a couple of baselining exhibits and charts to kind of give everybody a sense of what the Fed decided, what its outlook is, and kind of where we stand. So let's flip up the new SEP, the new Summary of Economic Projections. And it basically portrays what the Fed is thinking in terms of rate policy going forward based on certain economic expectations. And from what you can see in the table, they're expecting good economic growth for the next couple of years, some uptick in unemployment, which is entirely fair given what's just happened, declines in inflation, which again is fair given what's been happening. And the most important number to my mind to think about is that 2.9% number towards the lower right part of the box, which is the Fed's estimate of the neutral rate of interest, where they want to land eventually that keeps the economy growing and inflation in check and nothing bad happening. And that 2.9%, we're still far away from that. Their track of future Fed policy is looking for rate cuts of another 50 basis points this year, another 100 basis points next year, and getting to that 2.9% sometime in 26 or thereafter. The market is saying something else. The market is saying they're going to get there very fast. Fed funds futures are saying they're going to get there by the end of next year. This is the tailwind.
They're going to get to 3% Fed funds rate by the end of next year?
That is the modal estimate in Fed funds futures today.
Okay.
That's what the market's looking for. Much more aggressive than the Fed, obviously. But the market is saying, look, if all these things are basically okay and the labor market's kind of wobbling a little bit, the Fed's going to go faster, which that's the predicate for the equity market rally that we saw on Thursday and that we're seeing today. And I think we'll continue to see for the coming weeks.
The thing that jumps out at me, and maybe this is just a standard thing and they're always this way. I don't pay as close attention to it as you do. They're projecting 4.4% unemployment next year, and then they drop down to 4.3 in 26, and then 4.2 in 27. Now, of course, literally anything in the world can and will happen between now and then. Is this what they normally do going into a cutting cycle? Do they normally have unemployment that stable and then actually falling?
No, they usually expect it. Let's say you're cutting because you're in a recession. So you're going to have a high unemployment number in year one and it kind of trailing lower in year 2 and 3, getting back to kind of like that 4.5% range thereafter, which is the normal unemployment rate in an expanding economy. This time around, it's somewhat different. And Powell went through this in the press conference, mostly because we're seeing basically the job market is relatively saturated. There's not a lot more jobs left to have. So job growth is slowing and has been kind of ill reported over the past couple of months. So he's a little bit worried that unemployment is going to keep going up. So I think your point is very well taken. Unemployment is going to be higher than that 4.4% at some point in the next 6 months. So almost no doubt about it. It will go up. Does it mean a recession? Not necessarily. And Jessica's got some data on that in a second. We can look through. But the bottom line on that summary of economic projections is the Fed sees a stable economy and the ability to lower rates back to neutral. The market just thinks it'll happen faster.
Okay, let's keep moving.
This is the Atlanta Fed's GDP Now model, which is a very good real-time model of where economic growth is tracking over the course of a quarter. This is Q3. And as you can see, we're tracking between 2 and 3%. We're better than the economist estimates, which is the blue line and blue band. And it has not been trailing off this quarter, which means that as the data has been coming in, this model keeps banging around between 2 and 3% to Q3 growth, which is very solid given where we are in the cycle. And I think one more reason Powell's feel comfortable cutting by 50, but then talking about 25s thereafter, because we're not turning down. This line, that green line of estimates, is not trending lower. It's very flat, very nicely flat over the course of the third quarter based on all the economic data.
It looks like it's accelerating, guys.
Yeah, it hit a 3% number last week. That little tip at 3% has come back down a little bit. I don't try not to look at it too carefully. I just want to make sure that it's stable through a quarter, and it is.
That was a blip, probably related to. I'm just making this up, but maybe I have something that was related to. I think a much stronger than expected retail sales number. You think that's what that
well
explains
done?
That blip?
Well done. That's
Okay.
exactly what it was.
All right.
Good job. Yes, you got it. That's exactly the number.
All right. We don't need these other two boxes. Just focus in on me now. All right. What's the gasoline demand situation? Let me hear what
demand.
This is.
This is something we look for clients every single week when it comes out, because it's a weekly number, and it shows daily gas demand. The U.S. uses roughly 9.5 million gallons of gasoline every single day. And if you track that year over year, you get a sense of the growth in the economy, because in order to spend in many places, you have to drive somewhere. So this shows aggregate consumer discretionary driving and therefore demand. It was soft. That blue line is this year. The brown line is last year. We were comping negative in April, May, June, July. But as gas prices came down, the comps turned positive. The blue line went above the brown line. And we're comping +1%, +2% now versus year-ago levels, which means that we were at some risk, frankly, of a slowdown in the economy in late Q2, start of Q3. And things have really picked up since then because gas prices have come down. And the big takeaway here is it's very hard to have a recession when gas prices are declining. History just shows that very clearly. Again, Jessica's got a point on that in a second, so I'm not going to steal her thunder. But this is a good chart. This is a strong chart that shows economic growth is decent.
I love this because it's such a simple concept. And some of the worst recessions in history have coincided with gasoline prices that curbed demand because they were so high. So what we're saying here is that demand for gasoline is running ahead of where it was this time last year. And we know that prices are fairly low. And so in that environment, you're not going to have the commodity price related recession that maybe you might worry about, or you're not seeing demand fall off, which would indicate people being under a lot of pressure. Is that like the big takeaway?
That's the big takeaway. Yeah. And the last chart is the VIX. So this is the VIX back in 1990. It was invented in the late 80s after the 87 stock market crash. It launched in Jan 1990. This is every monthly VIX reading since 1990. And it shows where you end up with mid-cycle markets, what we call mid-cycle markets, where the economy is expanding, earnings are improving, stock prices are rallying, and they occur like clockwork. So early to mid-1990s, VIX below 19.5, which is the average. Mid-2000s, once again, the VIX below that average for a long period of time. The 2010s, a very long period of low volatility, rising stock prices. And we enter the same regime at the beginning of 23. And who knows how long it lasts, but this is entirely consistent with every past mid-cycle market back to 1990, so 30 plus years.
If you look at that mid 2000 teens period of just ultra low volatility for a prolonged stretch, the only two spikes above that 19.5 average are related to elections. You can see the late 2015 and then late 2019. Do I have that right?
Aug 2015 was the flash crash in ETFs.
Okay, all right.
Which was it was
mechanical.
Actually, the catalyst was the surprise evaluation of the yuan in August 2015.
Okay.
That kind of jacked volatility for a while, and it kind of lingered longer than you thought it would. But that was that. Otherwise, I mean, Jessica and I used to work at a firm with a huge options trading desk, and we would hang out with the options traders every day, and they were just miserable through this period. There was just no vol to buy, no vol to sell, and the vol of vol went nowhere.
Right. Well, they got their wish, but it never lasts long. Those high vol periods.
Yep.
Jessica, before we go to you, I just want to interject a couple of things in terms of, so this is how the Fed is thinking about what it just did. We got a blog post from Neil Kashkari at the Minneapolis Fed, and the takeaway for me is he said basically the data is still a little bit confusing, but it's clear that we're tight enough. So this is Neil in his own words. The FOMC targets 12-month headline inflation of 2%. It now appears that while it remains too soon to declare victory in our inflation fight, we have made substantial progress and the disinflationary process appears to be on track. So he doesn't think cutting rates by 50 basis points will take it off track. Obviously, he wouldn't have supported it. He also said other measures of the labor market show sign of easing. For example, nominal wage growth has fallen from a peak of well above 5% in the spring of 22 to a touch under 4% today. And vacancies and quits have fallen to pre-pandemic levels. Raphael Bostic of the Atlanta Fed gave a speech this morning, quote, inflation has fallen faster than I had expected, and the most recent data solidify my conviction that the U.S. economy is indeed sustainably on the path back to price stability. He also said, on the employment side of the ledger, clearly the red-hot job growth coming out of the pandemic is cooling. That said, the labor market is weakening, but it is not weak. It's slowing, but not slow. I think we could all broadly agree that those are common sense observations. That is, what we should hear out of the Fed. Is there anything you guys have to add to that or any reaction to that?
I mean, the vibe from both those comments feels like the market has it more right than the SEP in terms of cutting rates more than just, quarterly cuts of 25 basis points next year. Those vibes are, we got to stay on top of this and we'd like to get back to neutral rate kind of as soon as possible.
Yeah. Okay. Let's keep moving.
Yeah, so I was just going to take the other side of the trade here. Recessions have two causes, an economic or a geopolitical shock. So we have two charts that show what to look for that would indicate things are really rolling over. So this first chart shows the cadence of U.S. job growth at the start of recessions. It shows the monthly job gains and losses from 1990 to 2019. So it includes three economic downturns, 1990, 2001, and 2008 to 2009. So you can see the start of each recession saw 3 straight months of consecutive job losses, and in each case, one of those months showed job losses of at least 200,000 workers. So you can see in the chart, every expansion here had some instances of job losses, but recessions only start when businesses begin aggressively laying off workers, which is not currently the case. And another important point is it usually requires a specific catalyst. So in 1990, it was Gulf War I. In the early 2000s, it was the dot-com bubble bursting. And then, of course, came the 2008 financial crisis. As for a geopolitical shock, if we could just flip it, please, to the next chart. They cause recessions because oil prices spike. So Josh, you were getting at that earlier. So this chart shows the year-over-year percentage change in WTI prices from 1987 through 2019, which, just like in the last chart, captures 3 recessions. The dotted black line marks a level where oil prices fell 20% year over year, and we also noted the years when that happened in green. And then the years noted in red are oil price spikes that happened just before or during a recession. So what this chart shows is that lower oil prices tend to extend economic cycles and higher prices tend to end them. So you can see in the chart from 87 through 2019, there were 8 times when crude fell by at least 20% over the prior year. In 5 of those, 88, 91, 94, 98, and 2015, no recession followed over the next year. And in 2 of those, 2001 and 2009, the U.S. economy was already contracting. And the last example in 2019, there was a recession, but that was because of the 2020 pandemic crisis. By contrast, all 3 recessions from 1987 to 2019 came after oil prices rose by at least 80% over the course of the year. You could see that in 1990, 2000, and 2008. So in other words, a double is trouble. But like you guys touched on earlier, oil prices have been coming down, not up. So obviously that's a tailwind for American consumer spending.
There's an interesting question here that is not answerable yet, but maybe will be. It's possible, because the supply dynamics have changed so much, that information might not be as predictive as it used to be, because there's a scenario where there's an oil price spike, and that actually leads to a lot more economic activity in the United States. We're a net exporter of crude when we want to be, and that was not the case, obviously, in the 80s and the 90s. Do you think at all about the fact that we're producing so much more to satisfy our own demand than we used to, and whether or not an oil price spike, a temporary oil price spike, might not necessarily be as disastrous for employers to want to lay off people this time around?
Yeah.
I think Nick just wrote about that. If you want to, I'll kick it over to him.
So having lived through the 73 and 79 oil shocks, the bottom line is an oil price spike would certainly help Texas. It would probably hurt the rest of the country, is sort of the way to think about it.
And it won't offset.
Yeah.
Yeah. At the end of the day, the prices are the prices. So it's very hard for American budgets to incorporate a spike in oil prices quickly.
I guess the question is, how quickly can we react? I know you can't produce new oil the next day just because the price went up the day before.
No, and look, there was a supply issue in 79 and 80 because Iran shut off the spigots after the revolution, and there were literally odds and even days. Like in New York, you had to wait for your license plate to be an odd day to fill up on an odd day, and an even day to fill up on an even day. That was incredibly damaging to consumer confidence and the stability of the U.S. economy. It's not going to be that way this time because, like you said, we're producing a lot more. But prices double, you're going to get a recession. It won't be a recession in Texas, but a recession in every other state.
So if the Fed missed it, so I want to make the case for maybe why it wouldn't even matter whether they miss it or not, because the nature of doing a 50 basis point cut is, in the minds of people who follow history, something is probably really wrong. So may not be the case, but I wanted to share this chart with you. I thought it was really interesting. This comes from Jim Colquitt from Weekly Chart Review, and these are Jim's words. Let's start with the facts. The Fed has initiated or extended 9 rate-cutting campaigns over the last 30 years. 3 began with a 25 basis point cut. 6 began with a 50 basis point cut. The following chart shows with yellow circles the 25 basis point cut easing cycles. The red circle are the ones that start with a 50 basis point cut. And you can see the S&P 500 is the magenta line, and the green vertical bars are U.S. recessions. So Jim says, note the performance of the S&P 500 when associated with the red circles, which again are the 50 basis point cuts, versus when associated with the yellow circles, which are 25. History would suggest 50 basis point rate cuts tend to be associated with recessionary periods and an S&P 500 that is about to fall or already has. Here's the question. is 30 years and 9 cutting cycles enough to say anything definitive about cycles that start with 50 basis points versus 25 basis points?
Short answer, no. It just
Not
isn't.
enough. We just don't have enough information.
That is correlation, at best correlation and not causation.
Okay.
In our view. I mean, we did exactly this chart like 6 different ways for our clients in the 2 weeks before this decision. Totally understand where it's coming from, but you got to kind of take the situation as it stands right now. And as Jessica's, laid out very clearly, all those prior instances had a lot else going on besides the Fed. Yeah. And you have to put it all into context. So totally respect the analysis. It's just never say it's different this time, because it's different every time.
Yeah, and there needs to be like I said earlier, there needs to be a specific catalyst. It doesn't just happen.
There are so many things about this cycle that make it really difficult to look at anything historical and draw a conclusion, especially from a single variable. Yeah. And it's been that way for 3 years, and it's confounded everyone to some degree or another. So I think this is another example of that.
Mid-cycle markets we talked about this on every single one of these What Did We Learn podcasts. And the bottom line is mid-cycle markets are just as hard as calling a bottom or calling a top or figuring out where it's going in any other part of the cycle, because you always have things to worry about.
Okay, let's keep moving. Jessica asked the question, can tech outperform again? This is the question on everyone's mind, because people need to know whether or not to be over or underweight tech, given how important tech is to the overall market and the S&P's performance. So I'd love to hear what your thoughts are on this topic.
Yes. So earlier this month, we wanted to see if tech could actually outperform anytime soon. So I think you have a chart of the relative returns between the Qs and the S&P. If you could just, thank you. Yep. So that shows the 100-day trailing relative price returns between the NASDAQ 100 using the Qs and the S&P 500 over the last 20 years. We use 100 trading days because it's just under 5 calendar months. So we think that's a reasonable time frame to consider sector rotations. This shows when the blue line is above the x-axis, that means the Qs outperform the S&P over the prior 100 trading days. So what this chart shows is that the Qs underperform the S&P by a statistically unusual amount over the prior 100 trading days through September 9th. The Qs usually outperform the S&P by 2.1 points over any given 100 trading days, but it lagged the S&P by 3.2 points earlier this month, which is 1 standard deviation below average. When that happens, though, when the Qs trailing 100-day returns have underperformed the S&P by at least 1 standard deviation in the past, like it just did, it's gone on to outperform 2/3 of the time over the next 100 trading days, and also by almost 4 points, or more than the long run average of 2 points. And as you can see in the chart, there's been many times when the Q's 100-day returns have lagged the S&P by an unusual amount during mid-cycle markets, like we're now. But as Nick just talked about, but it tends to mean revert over the following 5 calendar months. So the upshot here is that history suggests the NASDAQ 100 will most likely outperform the S&P over the next few months. Another question, though, you could ask is, if you are bullish on tech like we are, do you have enough exposure? Because the S&P 500 has more tech exposure than most investment styles, market caps, and even geographic regions.
The index is more bullish on tech than most styles right now. Right.
Yeah, we have a table of that. If you want to throw it up, thank you. So this table shows the information technology sector's weightings across those categories. And remember, there are some big tech that's not in information technology, like Google, Meta, Amazon. But this shows that U.S. mid and small caps are very underweight tech versus the S&P, with the latter having over 2 to 3 times the exposure. But then you have at the other end of the spectrum, large cap growth is significantly overweight tech. It's like half tech. So investors here need to have an aggressively bullish outlook for tech and be okay with its volatility. In our opinion, probably the S&P offers plenty of tech exposure, but that's something to be careful about. It's also important to point out the you can see under investment styles, It's important to point out the extreme difference in tech weightings between the MSCI Min Vol ETF and the S&P Low Volatility ETF. So both ETFs aim to have lower volatility than the S&P, but tech, which is typically higher beta stocks, makes up a quarter of one and less than 5% of the others. So it just highlights the importance of checking and comparing products exposures to holdings and sectors.
Let's go back to that table, Jessica. This is a really important point. So you might have a financial advisor who's saying, I'm going to have a low volatility sleeve in my portfolio. But you're showing if you invest in the MSCI minimum volatility ETF, you're still 25% tech. If you buy the SPLV, which is the S&P low volatility, you're only 4% tech. That's like completely two different asset classes that's so far apart from each other. And this is the importance of looking under the hood and understanding, yes, it might have the word low volatility in the product, but you should really understand how they're getting that how that portfolio is being constructed, because it could have a radically different outcome for the end investor.
Yeah, that's right. So, like for example, the MSCI Min Vol ETF that tries to track pretty closely to the S&P 500's sector exposures. So that's why you still have a quarter, a quarter of it in tech.
So it will select for the lowest volatility technology stocks to get to the right technology weighting relative to the index, and the other one is just pure. What are the lowest volatility stocks?
Exactly.
We don't care what sector they're in.
Exactly.
Okay. I wanted to show you guys something that we put together just to illustrate this point. Because your point about oscillation is important here. It feels like a slingshot. When tech underperforms to this degree, somebody lets go of the rubber band and it snaps all the way back and it outpaces the market. That's like the main point that you're making, right?
Correct.
Okay. So this is the degree to which the sectors are out or underperforming each other. And I don't have the S&P on here. I just have the 11 sectors. This is January 24th through September 2024. You've got 28.5% returns for the XLU, which is the utilities. XLC, which is communications, which some of these tech stocks live in, plus 23%. It's not until the sixth sector where you get the XLK, tech, which is up 16% on the year. So tech is kind of middle of the pack, and it's really interesting to see it underperform to this degree. Do we know, do we know anything about the timing? When do these snapbacks, how long do you have to wait for these snapbacks typically to take place?
So the chart we used was 100 days, so basically 5 calendar months, just under it. So it would take us through January. So we think over the next few months it should outperform, and that'll incorporate the melt up that usually happens at the end of the year when volatility drops in November and December, and then hopefully that positive momentum just carries into the start of next year.
Guys, I wanted to throw buybacks into the conversation because for me, any talk about tech outperformance is going to involve buybacks. They are doing the biggest buybacks in the market, like record-shattering buybacks. And I think they're an important reason for why large cap tech looks so stable, especially in volatile markets, more so than you would have historically thought. So I wanted to mention one of the easiest things for a board of directors to approve right now is a authorized share repurchase, or to enlarge an existing authorized. It's almost riskless, especially if you think Kamala Harris regime is going to be taxing buybacks at a higher rate next year. Why not do them now? The week before last week, the S&P 500 had its best week of the year, which is back to November 23, really. And corporations were buyers during that week. Again, the best week of the year. It was a new record for buybacks, trailing 52-week buybacks as a percentage of the S&P 500 market cap also hit a record high above 2019 levels. We have a chart from Bank of America. So this is not in absolute dollar terms. This is a percentage of the S&P 500 market cap. And you can see we took out that 2019 high. The next thing I would say about this is the week before that week was the worst week of the year for the S&P, and corporate stepped up and bought them as well. So they are stepping in up markets and down markets to buy back their own stock. And again, I think it's a really easy decision to get made within a corporation, which is why we're probably facing a record buyback year by the time we get to the end of the year. Let me show you two more charts. This is buybacks by corporate clients, still off the historical highs in June, but pretty high. And the next one I wanted to show you, this is 4-week average buybacks versus total quarterly buybacks. And you can see, obviously, the 4-week average tends to lead a little bit. So we're probably in for a lot more of that activity. And just to put a bow on it, last week, Microsoft announced they had bought back $17 billion worth of stock in the year ended June, and a new authorization, raise its dividend 10%, and buy back another $60 billion worth of stock. And obviously, it rallied on that news. They do that very slowly, Microsoft, and they continue to add new programs as the old program is winding down. But I think you're going to get a lot more of this in tech, and I think that'll be part of the reason for why tech can outperform into year end, why it could snap back. I think people feel pretty confident that even in down weeks, those stocks will have a bid beneath them. Those stocks will have a buyer. What do you guys think about the importance of buybacks between now and year end?
Our perspective is that companies don't buy back stocks because they think their stock is cheap. They do
No.
it because they don't have other uses for the cash. So the reason why buybacks are so important, are so helpful, is because it signals capital discipline, and that's especially evident in tech. Big tech, for example, is hugely profitable, and buybacks show as much as they invest a ton in R&D, they have cash left over to return to shareholders. So it shows that they respect shareholder capital.
One of the items on the table that you just showed, Jessica, is how low the tech exposure is in the Dividend Aristocrats ETF. I was going to ask you guys, there's no way it's going to look like that in 5 years. Or maybe it'll take 10. Maybe it'll take 10 years, but that tech exposure in the Noble ETF is only going in one direction.
It may be, but at the same time, tech strongly prefers stock buybacks to dividends.
Yeah.
So they'll spend X on a dividend and 5X on a buyback.
Right. So they'll be the buyback aristocrats for sure.
Yeah,
So,
they'll be the share reduction. The repo ETF.
okay, we're gonna finish on. We're gonna talk corporate profits. This is like the other big question mark, other than the election. It's really hard to get a handle on why the stock market would keep rising in the absence of enough economic growth to help corporations grow profits. But we've seen from corporations in the last year and a half, they don't necessarily need strong GDP to keep the profit machine running. So I'd love to hear just like the broader view of what you guys see for corporate profits going forward.
Okay. The first chart on this topic, which we can just flash up, it's the sectors. This is the FactSet chart that shows sector level earnings growth for 2025. Those are the dark blue bars. And what we've done is note whether the group is seeing accelerating earnings growth from this year or decelerating in the green and red numbers at the bottom of each bar. And it's just a visual reminder that there's earnings growth going on, accelerating earnings growth going on across the S&P. Now, even if all these numbers are high, which analyst numbers always are, so we can assume that, we're still seeing better earnings growth and real earnings growth in almost every sector. There's very few exceptions. Comm services, financials, and utilities are the only ones expected to see decelerating earnings growth. Everything else is expected to show accelerating earnings growth. Even if you have to cut these numbers back, the earnings growth in the S&P is a lot more than just tech and AI spending.
Yeah,
it's
look
going
at
on
this.
almost across the board.
Nick, the biggest swing here looks like it's energy. Am I reading this right? It's going from negative 11% earnings growth. This year to
Yes.
to plus 22.3% next year.
I mean, one assumes that is purely because of a bounce back in commodity prices, which we may or may not get. So even Xing that out, I mean, look at industrials, for example. Industrial is expected to show accelerating earnings growth. So that's to me more of a tell that says the industrial economy is going to be okay, earnings growth is going to be okay. Look, I don't think the S&P is going to grow earnings 15% a year, but frankly, another 10 after the last 10, that's good enough. That's good enough for markets. That's the long run average in an expansion. That's a good number. That's enough to support stock prices.
Can we put that up? Can we put that up one more time? Healthcare is the leader. It's expected to go from 5.9% profit growth this year to 15.4% next year, or up 15.4 percentage points higher next year. Like, if you had to guess, how much of that is GLP-1 weight loss drugs? Is it like half of that or 3/4 of that?
It's a big number, yes.
Okay.
But let's, healthcare has also had a number of other challenges this year, which,
Yes.
this is the classic thing. Like when you have a bad year, all of a sudden you become bullish because the comps are so easy for next year.
Okay. All right. Got it. Okay.
So the second chart shows you another market. And this is something that we look at every single week for clients. We write this up literally every Sunday night. These are corporate bond spreads over treasuries, and that needs a bit of explanation. Corporate bonds have to yield more than treasuries, but the amount they have to yield more than, the spread, varies across time. When this market is worried about a recession, the corporates have to pay a lot more because the risk is high. And then as they worry less about recession, the spreads decline. The black line is investment grade spreads, and that's the left axis. The red line are high yield spreads, and that's the right axis. High yield obviously being riskier. And this literally reads like a seismograph of investor worries about the U.S. economy and corporate earnings. Remember, bond investors don't get upside the way equity investors do. If the company pays them back on time, they're happy. But they worry from time to time that the companies can't do that, so spreads increase. And on this chart, which goes back to 2015, we've got 3 recession scares, one in 2016, one in 2018, and then one in 2022, and spreads all blew out. And then we have one real recession in March of 2020. And in all those cases, spreads increased because this market is very twitchy about worries about corporate earnings. And right now, we're nowhere near those levels. We're nowhere near the average from 2015 to 2019. We're nowhere near the recession levels of 2022 or the other recession scares. And so this market is saying very, very clearly, corporate earnings are going to be fine. Cash flows are going to be good. If this market had any worries, those spreads would blow out in a heartbeat.
That's a really great way to think about that. If people are worried about earnings, they're definitely worried about whether or not companies can pay back their debt, and they would definitely be worried about holding that paper. So it's a nice, what would you call that? Like a confirmation or an affirmation that earnings should hold up.
It does 2 things in my mind. The first is it confirms the current valuations on stocks, because let's face it, we've got some high PE multiples out there right now. And secondly, it's a cross-check to say, here's a market that is not brave. Equity investors are brave. They are optimistic people. They look for the future. They look for growth. Bond investors do not care. They just want their money back. And when they get worried first, and they get worried large. And that's just not happening now.
So on the overall earnings growth picture, Adam Parker wrote a piece over the weekend, just level setting expectations. I'm going to quote Adam, and then I'd love to get your reaction on the DataTrek take on earnings growth, broadly speaking. Adam says the current bottom-up earnings expectations for 2024 embed 8.2% growth over 2023. While the economy is currently slowing, the bottom-up numbers nonetheless are embedding 15% growth for 2025 to $279 in earnings for the S&P 500, which is the point we made earlier. We think the economy is decelerating, but we think earnings are accelerating. Okay, it seems like one side has to win. We'll see what happens. He notes that earnings expectations for 26 are not available yet. So putting in a 10% growth expectation conservatively, which would be $307 in the out year, if those numbers are correct, and earnings grow 10% or more in 26, the market is already trading at 18.6 times those numbers. What do you think about that as kind of a level set and just like where things stand? Is that the way that you would think about the earnings outlook and what we're pricing in?
Yes, and all that math is absolutely correct, obviously, and it can make you worried, right? Because I think the 10-year average multiple on the S&P is about 18. So how are we trading for basically skipping a whole year and looking at 27 earnings?
Yeah.
And that's a fair observation. I would sort of say two other points, though. The first is rates are coming down, and there have been periods of time, like in the mid-2010s, when earnings went nowhere, rates came down and the stock market went up because the worries about recession were less because rates were coming down. And the second is these averages that we all talk about for the S&P, they're all based on an index that's changed a lot over the last 20 or 30 years. So if you do a 20 or 30-year average of PE ratios, you're including a time when ExxonMobil was the highest valued stock in the country. You're including a time when there was a recession. And if you think about why the market was trading for a 10 PE in 1982, it was because Paul Volcker had to crush the economy in order to get inflation down. Now we're in an instance where, knock on wood, the Powell Fed has been able to bring inflation down without crashing the economy. And that creates a lot of confidence in future economic growth and the future of the American economy generally. So yeah, it's a high multiple, but it's high for a reason. And as long as investors can continue to hold on faith that earnings will grow by some point and we don't get a recession, there's no reason for multiples to contract.
I was going to say in 82, you look at the makeup of the S&P and the largest weightings, and these are companies that, if they're lucky, 5 to 8% profitability. Nothing like a company like Apple or Nvidia or Microsoft that seemingly are able to preserve 20% plus margins for as far as the eye can see. So it's just a very different S&P than it was during other periods of time that helped to form that long-term average multiple.
Exactly. Like energy was, I think, 22% of the S&P in 1980.
Right. You guys are incredible. As always, I learned so much, and I know the viewers and the listeners appreciate all of your insights as well. I want to let people know how they can learn more. Of course, the easiest thing to do is to go to the DataTrek homepage and subscribe to Nick and Jessica, and you can get their insights 5 days a week. What's the URL? DataTrekResearch.com?
Yep.
Okay, guys, check out DataTrekResearch.com if you want to learn more about what subscribers are getting from Nick and Jessica each day when they open their inboxes. And guys, what's next? What I guess we'll see you again a month from now. Anything that we should be keeping in mind, or we'll save that for another day?
Oh, I think it's the old saying: "Sit tight, be right." Market's okay.
All right, you guys are awesome. Thank you so much for joining me today, and thanks to you. Yeah, please make sure you leave a like here and there, maybe a positive review, and we'll talk to you soon.